So I have a question for you. Do we pile into equities?
So you know me, Mark, I like to look at the individual client scenario.
Right,
but
so the answer is yes.
I guess the way I would look at that is that what's interesting now in the self-managed super fund space, where we're very heavily involved in self-managed super funds, there's about double the cash now sitting in self-managed super funds to what there was prior to the GFC. So we're spending a lot of time looking at individual client portfolios and saying to them, gee, look at this, you're low on equities, your allocation to equities is low. So at the moment, we're now starting to move back into there. We were a year ago, but we're now reassessing and moving in again, dollar cost averaging in. So the answer to the question is, generally speaking, we are now dollar cost averaging into the market because of the yields, and we still feel the Australian share market is good value.
And when you put them into those equities, what are you looking at? So I'm dollar cost averaging just across the curve. I'm just buying the whole index, or do I say, well, actually, I'm only going to buy the four majors in Telstra because that's, and Wesfarmers and whatever, you know?
It wouldn't be the whole index, because our philosophy at Navwealth is that clients have a core portfolio of 15 stocks, which will be their blue chip yield producing for our retiree type clients or pre-retirees, and then for the small cap, we go to managed funds for that. So, and let the fund managers do their job to select, good quality companies.
How many fund managers on the small caps do you like? And I don't want you to name any.
There's not
you
a
can
lot.
Name them if you like.
There's not a lot, but there are a few that we use. They've had a bit of a tough time in the last year or two, as we know.
Because it'd be hard to find a good one to do that at the moment, because it's been deadwood.
Yeah, the last couple of years have been hard for small caps.
Yeah, I think it's also hard for fund managers in general. You're trying to find, this is the fee I want to charge. This is the performance I've produced.
Yeah.
There's a distinct correlation to, I paid you too much for such a bad return. There's a relationship around that, so it's a bit challenging, isn't it?
Yeah, I think that's why we balance it up between direct assets and managed funds. So we'll have direct shares, we'll have managed funds, but when we choose managed funds, we tend in our practice not to choose blue chip managed funds.
Yeah, right. With the interest rates where they are, I mean, is that troubling the clients? By that I mean, if you're borrowing, it's great, but if you're trying to live off dividends, and traditionally you've been off term deposits, is that proving the bogeyman that I'm going from the safest asset that I can get, a term deposit, effectively, into, well, I'll buy the equity, and we would sit at FIG and go, hello, that's a low stuff.
Yeah, and obviously we've got to include bonds in there for those clients that are living off income. But we've been so lucky in Australia, haven't we? I mean, with our banking stocks producing unbelievably
high dividends
and franking credits on top of that, we've been so spoiled. I'm sure you find that when you're travelling the world and you see what's going on in other countries. I think we've been very blessed here in Australia because of our high dividends and franking. So I think some clients do have a higher weighting to that asset class, and particularly banks, than probably what they should have long term.
Yeah. And the term deposits are proving a burden because the banks. We had Steve Lambert here from the NAB last week, and he said, "Look, the reality is you can't pay any more. You just cannot pay any higher for term deposits because people are generating mortgages at such low rates, whether it be 4.5, 4.70. That's so. What are you going to pay for a term deposit? There's not much margin in it.
No.